Right now, the financial landscape feels like a high-stakes game of wait and see, and even the smartest investors are pausing, holding cash, and at worst, selling stocks like Apple in the billions. The market's looking like a bubble waiting to burst. Stocks are overpriced, debt is soaring, and Warren Buffett is backing out. What do they see that we don't, and should we be worried? In this video, we'll break down the warning signs and why top investors are taking action now. I'm unpacking what's making these experts hold back, the potential market meltdown on the horizon, Buffett's recent moves like selling off chunks of his top stocks, building up a record cash pile, and he's done this with a clear message. It's time to get out. So stick around, because I'm breaking down Buffett's concerns and, more importantly, what steps you can take to protect your own financial future. But first, let's talk about the elephant in the room, Buffett's cash pile, because it is massive. Berkshire Hathaway, his company, is currently sitting on an unbelievable $325 billion in cash. That's not just a rainy day fund, it's practically a rainy decade fund. But why would one of the world's best investors choose to keep such a huge amount of money just lying around instead of investing it? Historically, Buffett has always been big on keeping some cash on hand. He calls it his safety net, and he's used it wisely over the years, especially when markets are riding a bit too high. For instance, back during the late 90s, during the dot-com bubble, Buffett stood back from diving into tech stocks like everyone else, opting instead to wait for prices to cool down. And again in 2008, when the market was crashing, he had cash ready to snap up bargains while others were panicking. Fast forward to today, and we're seeing something similar. His cash reserves have hit an all-time high, suggesting he's gearing up for something big. Or more likely, he's expecting a storm on the horizon. So why so much caution? Well, part of it comes down to high stock valuations. Buffett has openly said he's struggling to find reasonably priced investments right now, and when he can't find value, he doesn't buy. It's as simple as that. But there is another twist to this. Buffett has hinted that higher capital gain taxes could be coming, especially given the current US debt situation. He's not only looking at high prices in the market, but also the potential cost of selling down the line. In other words, it might be smarter to cash out now at a lower tax rate than risk higher taxes later. Let's look into one of Buffett's favorite tools for gauging market health, the Buffett indicator. It's a straightforward but powerful measure that compares the total value of the US stock market to the country's GDP, essentially telling us how big the market is relative to the economy. When this ratio gets too high, it's often a sign that the market is, well, a little bit inflated. Right now, this indicator is one of the highest levels we've ever seen, hovering at around 210%. For context, during the dot-com bubble in 2000, the Buffett indicator was at about 140%. In the 2008 financial crisis, it was at 110%. Today, we're way past both of those. So what does that mean? In simple terms, the market's value is more than double what the economy is producing, which can be a red flag for potential trouble. But that's just one piece of the puzzle. Another big concern for Buffett is the US debt to GDP ratio. This ratio measures how much debt the government owes compared to the economy's total output. As of now, the debt to GDP ratio is around 120%, meaning that as a country, we owe more debt than we produce in a year. And here's where things get a bit sombering. Each American's share of this debt comes out to about $106,405. That's right. Whether we like it or not, that's what each of us would technically owe if we split up the national debt evenly. High debt levels don't just limit the government's ability to respond to future crises. They also make the economy more vulnerable to shifts in interest rates. When debt is high, even a small uptick in rates can significantly increase the cost of borrowing. And higher borrowing costs have a domino effect. They can lead to slower economic growth, reduced corporate profits, and ultimately lower stock prices. This is why Buffett pays close attention to both the Buffett indicator and the debt to GDP ratio. He knows that when markets are priced sky high and debt is piling up, there's less margin for error. Think of it like a rubber band stretched too tight. Any little nudge and it could snap. But let's be clear. Buffett isn't trying to predict exactly when the market will take such a downturn. Instead, he's making sure he's prepared if or when it does happen. That's why he's sitting on such a large cash reserve. His message is clear: I'm not buying at these prices. And for us everyday investors, that's a message worth heeding. When valuations are extreme and the economy is weighed down by debt, it's okay to be cautious and wait for better opportunities. Also, let's talk about one of the biggest wild cards in today's economy: interest rates. Right now, rates are higher than we've seen in previous years, and this has a ripple effect across everything from housing prices to stock valuations. For investors, high interest rates can be a double-edged sword. On one hand, they make borrowing more expensive for companies, which can slow down growth and put pressure on stock prices. On the other, they can also be a signal that the economy is overheating, which can lead to inflation, the very thing Warren Buffett is keeping a close eye on. Buffett has a reputation for keeping calm in uncertain times, and this time is no different. But while he believes in the resilience of the US economy over the long term, he's also being cautious in the short term. The real question is, could we be heading toward a period of hyperinflation, or on the flip side, economic slowdown? For context, inflation refers to the general rise in prices over time. We've all felt that at the grocery store, the gas pump, pretty much everywhere. Hyperinflation, though, is a whole different story. It's when inflation skyrockets so fast that the value of money practically disappears. Imagine paying double for the same cup of coffee within a month. That's the extreme side of inflation. Fortunately, hyperinflation is rare, but with the national debt climbing and ongoing talks of higher interest rates, some experts warn it's not entirely off the table. But what about the other side of the coin? Some economists believe that while inflation is a concern, we're also facing potential economic slowdown. Rising interest rates can lead to what's called stagflation, where we have inflation without much economic growth. It's a challenging scenario because people are paying more without seeing much increase in their earnings, and it puts a squeeze on spending and investment. If this happens, even long-term optimists like Buffett know it's best to stay cautious. And this brings us to Buffett's recent stock sell-offs and market strategy. Look, we know Buffett's holding a mountain of cash, but there's the other side of the coin. He's been selling off some major stock holdings, and not just any stocks. The biggest surprise? His decision to reduce Berkshire Hathaway's stake in Apple, which has been one of his most successful investments in recent years. Just to give some context, Buffett started investing in Apple in 2016, and it quickly grew to become his single largest holding. At its peak, Berkshire's stake in Apple was worth an eye-popping $178 billion. But in the last year or so, Buffett has cut down that position by over 2/3. As of the latest quarter, he's brought his Apple stake down to 400 million shares to about 300 million shares, effectively halving his investment. Now, Apple's still his top holding, worth around $69.9 billion, but this shift is a big deal. So, what's the reasoning here? Well, it's partly about high valuations. Buffett has said that he's not seeing much value in the market right now. And with Apple stock at elevated levels, it makes sense that he'd want to lock in some profits, especially as he sees fewer buying opportunities elsewhere. But there's another layer here: taxes. Buffett has hinted that he expects capital gains taxes to go up, especially with the US debt situation putting pressure on future tax policies. Selling some of his Apple shares now could save him and Berkshire on taxes in the long run. It's not just Apple either. Buffett has been trimming down Berkshire's stake in Bank of America, which is another major holding. Over the past few quarters, he's offloaded billions of dollars worth of Bank of America shares. This move has been a part of a broader pattern. For 8 straight quarters now, Berkshire has been a net seller of stocks. That's right, he's been selling more than he's been buying, even though he's historically known for scooping up bargains. In fact, the only significant buy we've seen from Berkshire recently has been more cash and short-term investments. This risk-off approach is all about keeping his options open. It's also worth noting that Buffett didn't buy back any of Berkshire's own shares this quarter, breaking a pattern since 2018. Typically, he's been comfortable repurchasing Berkshire shares when he feels they're undervalued. The fact that he's holding off on that suggests that even his own company's stock seems a bit pricey in today's market. All in all, Buffett's recent moves, reducing big positions, holding on to cash, and steering clear of overpriced investments, they're a clear message. He's preparing for a downturn, or at the very least, waiting for the market to offer better deals. So, what can we, the everyday investors, take away from Buffett's cautious approach? Here are a few strategies that can help protect and grow your money, even when the market feels a bit rocky. First off, patience is key. It's tempting to jump into every market trend or follow the latest hype, but sometimes the best investment move is, well, not making a move. If stocks feel overpriced or uncertain, it's okay to let your cash sit on the sidelines until a real opportunity shows up. Sometimes, waiting for the right moment is more valuable than diving in immediately. Next up, building a cash buffer. While you may not need billions sitting in your account, having a cash reserve can offer flexibility and peace of mind. It's a backup plan. If the market dips, you're ready to scoop up quality investments at a discount. Think of it as positioning yourself to buy low when timing is right. Diversification is another essential strategy. Rather than putting all of your eggs into one basket, a balanced approach spreads out risk and helps ensure that you're not too exposed to any single investment's ups and downs. Diversifying doesn't mean having hundreds of different stocks, just a mix that keeps your portfolio steady regardless of market shifts. So it all boils down to this. Here's your takeaway. You don't have to chase every opportunity. Sometimes holding cash, waiting for better prices, or simply diversifying can be the smartest approach. Want to find out the most undervalued stock opportunities right now to invest in? Click the video on the screen to find out.